Options trading is one of the most powerful tools in the investing world. It gives investors the ability to control large amounts of stock with relatively little capital, hedge against losses, and even generate income. But it can also be risky if not properly understood. In this video, we're going to break down everything you need to know about trading options, from the absolute basics to advanced strategies, so that by the end, you'll understand how options work, how to use them, and how to manage risk effectively. Let's start with the foundation. An option is a financial contract that gives you the right, but not the obligation, to buy or sell an underlying asset, usually a stock, at a predetermined price within a certain time period. There are two main types of options: calls and puts. A call option gives you the right to buy a stock at a specific price, while a put option gives you the right to sell it. The price at which the stock can be bought or sold is called the strike price, and the date when the option expires is called the expiration date. When you buy an option, you pay a premium. That premium is the cost of having the right to buy or sell the stock. It's similar to an insurance policy. If the stock doesn't move in your favor, you can simply let the option expire worthless, losing only the premium you paid. But if the stock does move as you anticipated, your returns can be significant because options offer leverage. You're controlling more shares for less money than buying them outright. Let's walk through a simple example. Imagine a stock trading at $100. You believe it's going higher, so you buy a 1-month call option with a strike price of $100 for a premium of $5 per share. Since each option contract controls 100 shares, this option costs you $500. If the stock rises to $110 before expiration, your call option now gives you the right to buy at $100 and immediately sell at $110, creating a $10 profit per share. Subtract the $5 premium, and your net gain is $5 per share, or $500 total. You doubled your money because you turned $500 into $1,000. But if the stock stays below $100, your option expires worthless, and you lose the $500 premium. That's the trade-off: limited loss, but the potential for large gains if the move goes your way. Now, let's flip it around. Suppose you think a stock is going to fall. You can buy a put option instead. A put gives you the right to sell a stock at a certain price. If the stock falls below the strike price, the put increases in value. For example, let's say the same stock is at $100, and you buy a 1-month put with a strike price of $100 for a $5 premium. If the stock drops to $90, you have the right to sell at $100, meaning the option is worth $10. Subtract the premium, and your net profit is $5 per share. So far, we've covered buying calls and puts, but there's another side to every option trade: selling. You can also sell or write options contracts. When you sell a call or a put, you receive the premium up front, but you take on the obligation that comes with the contract. For example, if you sell a call option, you're agreeing to sell your stock at the strike price if the buyer decides to exercise the option. If the stock rises sharply, you could be forced to sell your shares at a price far below the current market value, losing potential gains. On the other hand, if the stock stays below the strike price, the option expires worthless and you keep the premium as profit. Selling options can be used as an income strategy, particularly with covered calls. A covered call is when you already own the stock and sell call options against it. Let's say you own 100 shares of Apple at $170. You could sell a 1-month call option with a strike of $180 for $3. That means you collect $300 in premium. If Apple stays below $180, the option expires worthless and you keep your shares and the premium. If it rises above $180, your shares are sold at that price, but you still keep the premium. It's a great way to generate extra income from stocks you already own. Another popular strategy is selling cash-secured puts. This is where you sell a put option on a stock you'd like to own at a lower price, while setting aside enough cash to buy it if you're assigned. Suppose Tesla is trading at $250 and you'd like to own it at $230. You could sell a put option with a strike of $230 for a premium of $5. If Tesla stays above 230, the option expires worthless, and you keep the $500 premium. If it falls below 230, you'll be obligated to buy the stock at that price. But effectively, your cost basis is $225 after factoring in the premium. These are examples of conservative strategies, but options can also be used for hedging. Imagine you own shares of a company that have performed well, but you're worried about a short-term pullback. You could buy a put option to protect against downside risk. This is called a protective put. It's similar to buying insurance for your portfolio. If the stock price drops, the put increases in value, offsetting some of your losses. Now let's move into how options are priced. Option prices are influenced by several factors known as the Greeks. Delta measures how much the option price changes for every $1 move in the underlying stock. Gamma measures how much delta itself changes as the stock price moves. Theta represents time decay, which means options lose value as they get closer to expiration. Vega measures sensitivity to volatility. When volatility rises, option premiums increase, and when volatility falls, they decrease. Finally, Rho measures sensitivity to interest rates, which is less relevant for short-term traders but still part of the pricing model. Time decay is one of the most important concepts in options trading. Every day that passes, the time value of an option erodes. This means that if the stock price doesn't move enough in your favor, your option can lose value even if the stock hasn't changed much. That's why many traders who buy options focus on short-term momentum and volatility, while those who sell options often take advantage of time decay by letting the clock work in their favor. Another key factor in options trading is implied volatility, often abbreviated as IV. It represents the market's expectation of how much the stock will move in the future. Higher implied volatility means higher option premiums because there's more uncertainty about future price movement. Earnings announcements, major news events, or market turbulence can all increase volatility. Traders often sell options when implied volatility is high and buy them when it's low, aiming to profit from volatility returning to normal levels. Now, let's talk about spreads. An option spread involves combining two or more options to create a position with a specific risk-reward profile. For example, a bull call spread involves buying one call option at a lower strike price and selling another at a higher strike price. This limits both your upside and downside, but it reduces the cost compared to buying a single call. A bear put spread works similarly, but in the opposite direction. You buy a put at a higher strike and sell another at a lower strike. There are also neutral strategies like the iron condor, which involves selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. This strategy profits when the stock stays within a certain range, benefiting from time decay as the options lose value. It's often used in quiet markets when traders expect little movement. Options can also be combined with stock positions to manage risk or generate income. For instance, married puts combine owning stock with buying puts for downside protection. Collars involve owning stock, selling a covered call, and buying a protective put. This strategy limits both upside and downside, creating a more stable return profile. Trading options requires discipline and risk management. Never risk more than you can afford to lose, and always understand the maximum potential loss before entering a trade. Beginners should start small. Use options on companies you're familiar with, or practice in a paper trading account first. It's also important to understand assignment risk. When you sell an option, you can be assigned at any time before expiration if the buyer exercises their rights. This means if you sold a covered call and the stock price rises above the strike, your shares could be called away early. Similarly, if you sold a cash-secured put and the stock drops below the strike, you could be assigned to buy it sooner than expected. When trading options, always keep track of expiration dates and strike prices, and pay attention to earnings announcements and dividends, as they can impact option prices and exercise behavior. Options can also be used in portfolio management for broader strategies. Institutional investors often use options for hedging large portfolios, protecting against market downturns, using index puts or volatility products. Retail investors can use index ETFs or options on the S&P 500 like SPI options to manage risk on a smaller scale. Finally, remember that successful options trading isn't about predicting the future. It's about managing probabilities. Every option has a probability of expiring in or out of the money, and tools like Delta can help estimate those odds. By focusing on risk-reward ratios, position sizing, and diversification, you can use options strategically rather than speculatively. In summary, options trading opens up a world of flexibility. You can profit from rising markets with calls, from falling markets with puts, and from sideways markets with strategies like spreads and condors. You can protect your investments with hedges or generate income by selling covered calls and cash-secured puts. But all of this only works when you fully understand the mechanics and risks involved. Take your time to learn, start small, and build experience gradually. Options can be an incredible tool for building wealth and managing risk if used wisely. And remember, trading isn't about being right all the time. It's about managing risk and staying in the game long enough for the probabilities to work in your favor. If you found this tutorial helpful, make sure to like, subscribe, and leave a comment with any questions or strategies you'd like to see explained next. Options trading can seem complex at first, but once you understand the moving parts, it becomes one of the most versatile and rewarding ways to trade the market.